Good afternoon, everybody, and welcome to our Defensive Income Solutions webinar brought to you by BetaShares. We're really happy to have a good number of attendees here to listen to this particular topic. My name is Ilan. I'm one of the co-founders and head of strategy of BetaShares Capital. A couple of bits of housekeeping before we get started. First of all, just to let you know that this information is general information only. It should not be construed as personal financial advice. Obviously, any information we provide does not take into account any of your or your client's personal circumstances. And please do read any of our product disclosure statements if you have more requirements or information about our particular funds. Housekeeping-wise, for those of you who haven't attended these before, there will be a recording and the slides of the webinar sent to all of our attendees and registrations today. You can ask questions by using the questions widget that you probably can see on your screen today. So please go ahead and do that anytime throughout the presentation, and we will endeavor to respond either during or at the very end of the prezo. And finally, we do have some handouts as well. So you will see a section on your screen called handouts, where you'll see some information about some of the funds we'll be talking about today, some of BetaShares Defensive Income Solutions. Without further ado, I'll talk about our speaker today. So our speaker today is Peter Harper. He's an executive director and co-head of distribution and capital markets in the business. He's been with the business from almost day dot. Formerly worked at Macquarie Bank and ABN AMRO and UBS. He'll be taking us through the discussion on defensive income. And before we do that, just a bit of interactivity to ask you a quick question, which you'll see on your screen. And that is, in 12 months' time, how do you expect the Australian Stock Exchange to be trading? Do you expect it to be higher than it is at the moment, approximately the same at the moment, or lower than it is at the moment? Just give you some time to respond to that. Thank you. Once again, the question, in 12 months' time, how do you expect the Australian Stock Exchange to be trading relative to today? Higher than today, approximately the same as today, or lower than today? Now I will just share the responses to that, and I personally find them quite surprising given what we've heard in the market. So about 50% of you think that it should be higher than today. A good number think it'll be about the same, and 21% lower. So certainly you can see there's not overriding bullishness in the room, but I guess generally people expect it to be higher. We obviously didn't ask how much higher, but that would be another interesting question to ask. And then just because we're talking about defensive income, the second question we ask here is as follows: what percentage of your clients' portfolios are currently allocated to defensive income products? Now, defensive income products for us will be anything below equities, so hybrids through to cash. So what percentage of your clients' portfolios are allocated to defensive income products? Just let those questions get answered. And to show the responses to that, possibly the BAM was a little too large, but vast majority are in the 26 to 50% category. Interestingly, there's around 11% who actually have it 50% and above, and a reasonable proportion that's below the 25% range as well. So this, I guess, sets the backdrop for what we have seen, which is a tremendous amount of interest in defensive income. And we thought we'd take this opportunity to talk about how advisors should be thinking about this particular strategy, some of the new exposures that are out there, and sort of ways to think about defensive income solutions using exchange-traded products. So without any further ado, I'll hand this over to Peter Harper to take us through this.
Thank you, Ilan, and thank you very much to all of you for joining us today. It's great to have you with us. So let's have a look now. What we're going to cover today, obviously the growth of fixed income exchange-traded products and the range of exposures that are currently available. We're also going to look at a comparison of traditional fixed income portfolios and how that can be compared to next generation defensive income products. And look at a bit of a checklist on how to select the right defensive income exchange-traded products for your needs. Here we've got the growth of the fixed income ETF segment in the Australian market, and you can see there that from about mid 2014 through to today, there's been very, very strong growth in fixed income, and that growth rate has actually been accelerating. If we go to the next chart, you'll see that first of all, 2017 was a record year for growth of fixed income. And 2018 looks on track to actually surpass that by about 20%. Now, there could be a number of reasons why fixed income is growing so strongly. Certainly, the longer you get into a bull market, the more risk-conscious investors may become. But we're also seeing global bond yields go push higher. And one thing that can be said is that as global bond yields rise, what that does is incrementally and little bit by little bit, it makes fixed income relatively more attractive when compared to equities. So I think the rise of global bond yields could be another factor pushing the growth of fixed income ETFs. Now, obviously, fixed income is but a part of asset allocation. When we think about asset allocation, obviously the backbone of that historically has been an equity and bonds sort of portfolio. When you think about equity, you earn a return from taking on equity risk. That return is generally higher than what you would get in fixed income because the risk is higher. When you look at fixed income as a broad asset class, though, there's actually two components to the asset allocation of fixed income. And those two components are duration and credit. So fixed income is made up of those two separate return elements. You might have all of your return being generated from one or the other, or you might have a return that incorporates elements of both. But duration is effectively the return that you receive for taking on interest rate risk. It is your compensation for the opportunity cost of tying up your money for a period of time. And the longer you tie it up, the higher the compensation you would generally expect to receive. Credit is the return from taking on credit risk. And the riskier any investment is over the, say, government bond risk, which is considered the risk-free rate, the higher the return you would expect to be compensated with. So when you look at fixed income, you need to consider and break it down to its two elements of return, being both duration and credit. What this chart here shows is effectively that, duration and credit. As you move along the horizontal axis, you'll see starting on the left, we've got a range of fixed income exposures there. There's the AAA cash ETF, which sits highest in the capital structure and therefore has the lowest level of credit risk. And then as you move to the right, you move to senior floating rate bonds, and then out to hybrid securities, which again sit lower in the capital structure and therefore should be expected to have a higher level of return because of higher level of credit risk. So all those exposures along the bottom of the chart, moving left to right along the horizontal axis, AAA coupon hybrid, you can see there that your return in those investments is being driven by taking on credit risk, not duration, because all of those exposures are floating rate exposures and they just step down gradually in the capital structure to enhance the expected return. The vertical axis shows the return expected from interest rate risk or duration. And as I just said, you would expect to be paid more for the opportunity cost of locking up your money for longer. So as you start moving vertically up that chart, those exposures start demonstrating higher levels of duration and therefore higher levels of return or expected return from interest rate risk. And you can see there the two common benchmarks in the Aussie market of the Bloomberg Ausbond Composite Index and the Bloomberg Ausbond Credit Index. But right up the top, also the new cred exposure from BetaShares, which is investment grade corporate bonds of fixed rate variety. Just tick along now and look at a comparison of some of the problems that we've seen in fixed income markets over history, I suppose. So when we look at some of the problems with common fixed income benchmarks, and I suppose an example of this, but not the only example, would be something like the Bloomberg Osborne Composite, which is widely used as a benchmark for fixed income in Australia. One of the issues you see generally with these broad market benchmarks is that they tend to be liability weighted. What that means is that the more indebted the issuer is, the bigger their weighting tends to be in the index. So you're lending more money to the most indebted issuer. They also have very unstable risk profiles, subject to both duration creep and segment creep. Now, to explain that, probably the largest component of something like the Bloomberg Osborne Composite Index would be the weighting to government bonds. It tends to dwarf the exposure of any other type of bond within that index. And anytime the government issues a new bond, it almost certainly is of large enough scale to get added to that index. So what you find is that your investment profile for something like a composite benchmark is actually being driven by the funding requirements of the federal government. As they issue new bonds to fund their balance sheet, those bonds get added to the index and change the profile of the index. So as an example, if you looked at the duration of the Bloomberg Osborne Composite going back a couple of years, it was probably sitting at about 3.5 years duration. That's now up to about 5.2 years of duration. Why? Because the federal government has been issuing longer dated paper in a low interest rate environment. So that change in duration in that index is known as duration creep. And that's a problem for investors because you don't know what future duration changes might be in that index. How do you use an exposure for an asset allocation purpose if you don't know what the outcomes are going to be? And without knowing the duration profile, you cannot know the future outcomes. Similarly, there used to be a fairly large credit component in the Bloomberg Osborne Composite. That has now been dwarfed by federal government issuance as our governments run deficits. And now it virtually has very little credit exposure. It's now virtually a government-style pure duration exposure. So again, if you'd invested in this index a few years back, you may have had a more diversified exposure to credit and duration through government bonds. Now, these days, it's much more duration heavy and much lower exposure to credit. So I'd sum this up and ask a question of investors, and that is, why does it make sense to do these three things? Why does it make sense to lend more to the most indebted issuers? And I would argue that it doesn't. Why does it make sense to buy an investment whose future outcomes are controlled by the whims and funding needs of the federal government? And I would argue it doesn't. And why does it make sense to buy an investment whose future outcomes cannot be predicted as a result of segment creep and duration creep? And again, I would argue it doesn't. So we believe that the existing benchmarks for fixed income in the Aussie market are fairly flawed, and that investors need to look for better ways to gain fixed income exposure. So I've touched on many of these, but traditional fixed income benchmarks were never designed to be invested in. They were designed to be a representation of the market, not to be a tracker of the market. As such, they tend to contain many illiquid exposures, and they're difficult benchmarks to physically replicate. And that means that for a fund manager trying to replicate those benchmarks, they often have to engage in sampling or own rather obscure and illiquid bonds in order to try and replicate that benchmark, which comes at a cost. Something like the Osborne Composite, as as I mentioned, is dominated by duration with little benefit from credit. So that tends to mean a lower return and lower efficiency for an investor. And the duration creep, which I think I covered pretty well in the last slide, obviously leads to lower predictability of future returns. And that puts an asset allocator in a very, very difficult seat if you can't predict accurately the future expected returns. So for a lot of investors, the solution that they've gone to has been to move towards active management in the fixed income space. Now, undoubtedly, there are some active managers who have provided good returns, and you'll find that in most asset classes. So by no means are we entirely negative towards active management. However, the stats say it is very difficult to invest in a fixed income manager that is likely to outperform over the long run. The annual SPIVA report from S&P showed that in 2017, 69% of active managers underperformed the Australian fixed income benchmark. Over the last 10 years, that number is 85% of active managers have underperformed the benchmark for fixed income. So that tells you that it is very difficult for an active manager to beat the traditional benchmark returns. And so going active hasn't been the answer either. There's also one critical thing to consider when looking at active management, and that is how does it offer, what sort of diversification does an active fixed income exposure offer to an asset allocator? Now, whilst every fixed income exposure is different, historically, many active managers don't consider their portfolio and how it fits as part of an overall asset allocation. They only consider how their portfolio looks when measured to a fixed income benchmark. As a result, their goal is to generate better risk-adjusted returns than something like the AusBond Composite Index. Now, if you want to improve the risk-adjusted returns of any fixed income investment, the easiest way to do it is to pull in your duration. The lower your duration, the lower your volatility. And as your volatility moves towards zero, your Sharpe ratio shoots through the roof. Cash, for example, has an infinite Sharpe ratio. So traditionally, many active managers have sought to beat a fixed income benchmark by pulling in duration to reduce volatility and improve risk-adjusted returns. But by pulling in duration, they actually lose return, absolute dollar value of return. So to get that back, they've tended to upweight credit exposure in their portfolios. So they end up with a portfolio that's overweight credit and underweight duration. Now, that is perfectly fine if you invest in fixed income and fixed income only, maybe a retiree with 100% allocation to fixed income. However, if you're using fixed income to diversify equity risk, that can potentially create a problem because, as we'll see later on, when you look at historical correlations, duration is negatively correlated to equities, so it provides diversification from equities. Credit is positively correlated to equities, does not historically provide diversification to equities. So if you're invested with an active manager who's gone underweight duration and overweight credit in order to generate a better risk-adjusted return than a fixed income benchmark, then in an equity sell-off environment, you could find that your bond portfolio is susceptible to sell-off at exactly the same time as your equity portfolio. A perfect example of this happened this year during the Italian debt crisis, where we saw equity sell off, and Bill Gross's portfolio, and obviously Bill Gross ex-PIMCO, one of the doyens of global fixed income investing, he saw his fixed income portfolio sell off by 3% in a day at the same time as equities were selling off during the Italian debt crisis. Now, that's a massive sell-off for a fixed income portfolio and highlights the lack of diversification from equities in some fixed income portfolios. So just waiting for a couple of slides to roll on. We're now going to look at how you might select the right defensive income exchange traded products. When we think about fixed income at BetaShares, there are a few key product principles that we really hold at the core of the exposures we try and deliver. The first is to deliver efficient, liquid and low-cost sources of risk premia that help serve as an asset allocation building block for advisors. This results in us developing indices that recognise OTC liquidity and can be easily replicated in a way that many of the traditional indices cannot. And what this leads us to is the fact that fees matter, as do bid-ask spreads. So the more liquid you can make your portfolio, the more liquid your bid-ask spreads, and the easier that portfolio is to trade, helping to reduce MERs. Now, in a low return asset class like fixed income, having those lower MERs and tighter bid-ask spreads is, in our view, critical to any investment that you consider. Finally, we also try to think about fixed income as the sum of several parts, and therefore we try to put products into the market that form the building blocks of portfolios and that shouldn't be considered necessarily in isolation, but perhaps in combination. So we spoke about the floating rate exposure moving from AAA for cash to coupon for senior floating rate bonds down to hybrid for hybrid securities. I mean, they're all floating rate product and moving down the capital structure, which enables investors to pick and choose what level of risk return profile is most appropriate for them. But then consider something like CRED, which is senior fixed rate corporate bonds, and that adds a duration element. Now, as an example of combining two exposures, CRED is deliberately long duration, and we'll explain why in a little bit of time. But let's imagine you wanted to hold an exposure that matched the duration of the AusBond Composite Index at 5.2 years. You could blend 80% CRED with 20% coupon, and that would give you a duration profile in line with the AusBond Composite Index. But it would generate returns that are a yield to maturity that was about 115 basis points higher than AusBond Composite. So think about the various building blocks, not in isolation, but how they can be put together to blend and adapt and adjust both duration outcomes and credit risk outcomes to get the optimal portfolio for any individual client.
I'll just stop you there just to get you to answer a quick question, which should be a reasonably fast one. So just to clarify what's meant by OTC liquidity, which is on that slide, the second point on the slide, OTC liquidity.
Okay, so virtually all bonds in the Australian market are traded in the OTC market, which means the over-the-counter market. So the vast majority of bonds are not listed on an exchange such as the ASX. So when it comes to fund managers and direct investors trying to access bonds in size, they generally need to try and access an over-the-counter market in order to purchase those bonds. The over-the-counter market, as it sits currently, is where the majority of liquidity sits, although obviously things such as bond ETFs and some of the direct exposures the ASX has put into the market are working towards trying to move fixed income liquidity more onto a market-traded platform. But I would say that is still in its infancy.
Thanks.
All right, let's have a look at a checklist for selecting the right fixed income exposures. The first thing, in my view, that investors should consider is what is the purpose for them in holding fixed income. If they are holding fixed income to provide diversification away from equity risk, then floating rate product is probably not going to provide much diversification. It may provide low correlation, but it is still likely to be correlated positively to equities nonetheless. So someone looking for fixed income to provide negative correlation and true diversification from an equity portfolio needs to consider duration as part of their portfolio. Other factors to consider are stability of income. Obviously, a fixed rate exposure tends to provide a more consistent dollar value of income, regardless of current market movements, although that comes at the expense of potential capital fluctuations. Floating rate exposure may provide a higher level of capital stability, but income can rise and fall, and that could be a benefit or a detriment based on current market interest rate levels. What is your view on the market? If you think rates will stay lower for longer than what is priced into the curve, then it probably makes sense to take on some duration because current market interest rate expectations are priced into the existing fixed income curve that duration exposures are built off. If you think rates will rise in line with what the fixed income curve is already pricing in, then both duration and floating rate could be a suitable option for investors. And if you think rates will rise higher or faster than what's priced into the curve, then if you are happy to ignore the diversification to equities that duration provides, you may find better total return outcomes from being in a floating rate exposure. Aside from that, other important factors to consider are fees and liquidity, return potential, and of course the underlying quality of the portfolio. So here are some objectives that investors might consider and some examples of funds that might meet those. Just on a pure high yield basis, clearly the yield of any exposure will depend on the underlying investments that are held. Cash, as in AAA, will yield less than long duration investment grade corporate bonds in cred. But all four of those products are currently showing very strong levels of yield to maturity and return relative to alternatives in their particular universe. Is capital stability of paramount importance? Look, all fixed income exposures are likely to demonstrate relatively high levels of capital stability compared to something like equities. But if capital stability is important, then floating rate exposures such as AAA, coupon and hybrid tend to demonstrate higher levels of capital stability than fixed coupon bonds, because as interest rates move up and down, their adjustment mechanism is in the yield to maturity that they pay through, whereas for a fixed coupon bond, the adjustment mechanism is the capital value of the underlying investment as interest rates change. And as I've said several times, if it's diversification from equities, then duration is really what provides that, not credit. So you need to be looking at a product that provides higher levels of duration. Another factor that I think is critically important, and I touched on it just then, is spreads and fees. The lower your fees and the tighter the spreads, the more money that goes into the investor's pocket. Now, what you'll see here is that for every cash and fixed income and hybrid exposure that BetaShares offers, you'll see we're at or very close to the lowest MER for that particular exposure class and the tightest bid-ask spreads in pretty much all areas we offer an exposure. Now, that comes about as a result of our focus on holding the most liquid constituents and holding portfolios that are easily replicable, as opposed to some of the broad market benchmarks that we discussed earlier that hold sometimes obscure and illiquid exposures and were never designed to be investments. They were designed to be market measures, I suppose. Now, this is particularly important in low return asset classes because you cannot afford to be giving away fees and spread in an already low return environment. The other factor is that this demonstrates, as I said, the liquidity of the BetaShares product lineup in this space. And why that's important is we're talking here about defensive products. You are in a defensive product as an investor because you want to know that if things go bad in the market, you can be in something defensive and you can access that capital. That is where liquidity is paramount. This is where I think our product suite stacks up in a very compelling manner relative to what is available in the rest of the market. Finally, I would just highlight that all BetaShares funds are rated recommended or above by Lonsec within the cash, fixed income and hybrid space. So let's just touch on some of the funds in one by one in slightly more detail now. The first fund here is one of our longest running. It's the BetaShares Australian High Interest Cash Fund, ticker AAA. A very, very simple exposure. Almost all investors are familiar with cash management trusts, just conventional unit trusts that hold cash investments. And that's exactly what AAA is, a conventional unit trust that holds cash deposits. The only difference is AAA is listed on the ASX. So you're looking at a current return after deducting all fees in AAA of about 2.01% per annum. So that's about 50 basis points over the RBA cash rate. So we've found that particular exposure tends to resonate very strongly with advisors who are holding cash on platform. Generally speaking, platform rates of return on cash can be quite low, and holding AAA could be a way to very simply boost returns on that. And you can see the banks there that we hold cash deposits with. The fund settles T+2, so that's in line with equity. So if you wanted to sell AAA and buy, say, BHP, you could do that on the same day, and because the settlement dates are the same, the settlement proceeds would just contra off on settlement date. Taking one step down in the capital structure from cash, which is obviously at the top of the capital structure, down to senior floating rate bonds, we offer the coupon exposure, QPON, and this is senior floating rate bonds from major Australian banks. 80% of the senior bonds are from the big four banks, equally weighted, with the remaining 20% from the regional banks, including the likes of Macquarie. Now, why we think senior floating rate bonds are interesting is that, does a senior floating rate bond have the capital stability of a cash investment? The answer is no. But as you'll see in a second, they nonetheless do have very high levels of capital stability. The other thing to remember is that senior floating rate bonds have the same default risk as cash deposits. So a default on a cash deposit triggers a default on a senior bond, and vice versa. Now, it may be in wind-up that cash sits above senior bonds, but nonetheless, a default on one triggers a default on the other. So if a bank were to default on a senior bond, they wouldn't be able to pay out interest on cash deposits, for example. So, for a very, I would deem small step down in the capital structure, you can actually boost your returns over, say, the RBA cash rate by about 130 basis points. So about an additional 80 basis points over what you can see in AAA. So for some investors, that return is quite attractive relative to the incremental risk when compared to cash. I've largely covered what it is that coupon holds. I'll just highlight that all of the bonds in this exposure must be senior FRNs denominated in Aussie dollars and eligible for use in the RBA's domestic market operations. they must have an outstanding amount of at least 500 million, and they must have a maturity greater than 12 months and not more than 5 years. Because as bonds approach maturity, their liquidity tends to decline substantially as people just hold them to maturity. So all of those factors go back to what we were talking about before, creating the most liquid fixed income exposures in the market, which is very important for a defensive asset class, and additionally helps promote tight bid-ask spreads, which at the end of the day reduce real-world costs to investors. There's one other element to coupon that I wanted to highlight that is often misunderstood. Many investors will understand that a fixed income exposure earns a yield to maturity, but they often think that that is the sum total of potential returns. In fact, it isn't always the sum total of potential returns. What I've got here is an example of the Big Four bank FRN traded margin curve. And it goes out along the horizontal axis from 1 year, 2 year, 3 years out to 5 years. And the vertical axis shows the traded margin. Obviously, with an upward sloping curve, the further out in time you go, the higher the expected level of traded margin or return. So coupon tends to buy bonds on issuance at 5 years to maturity. If we looked at that curve and we said, okay, what's the yield on a bond with 4 years to maturity from, say, NAB, and a yield to maturity on a bond with 5 years from NAB, all other factors being equal, you would expect a 5-year bond to have a higher yield to maturity. So if you imagine coupon buying bonds on issuance at 5 years to maturity, 1 year later, when those bonds now have 4 years to maturity, all other factors being equal, they should be now trading on a lower yield to maturity or traded margin, which means that they in all likelihood have experienced a degree of capital gain. If, as coupon does, we rebalance on a regular basis into new issuances, then we're selling down those older bonds in the portfolio that have, all other factors being equal, experienced capital gains, and we're putting that money back to work in newly issued bonds at par, and therefore crystallizing those gains and locking them in for good. If you were to hold a bond to maturity, then obviously you would experience some gains as the bond maturity rolled down the curve, but all bonds must mature at par. So that gain gets sucked away from investors via decay effectively as a bond matures. So we're rolling out of them and locking in those gains before they get pulled away from investors. And they're locked in for good once we do that. So that we expect, that's what we refer to as roll return. And it's a return in addition to the yield to maturity. So that's something we think is often forgotten or misunderstood by many investors. So we look now at the characteristics of coupon, and you've got an average yield to maturity there of about 2.8%, plus an expected roll yield of about 30 basis points, which gives you, all other factors being equal, an expected total return of 3.14%. So when thinking about your expected total return, think about not just the return potential from yield to maturity, but also the return potential from roll return. I'll just point out two things here. If we look at the row for coupons index, volatility of 0.5%. Now that's an incredibly low level of volatility relative to equities, which have sat at, say, 17.3%. So not zero volatility as cash would have, but nonetheless a very low level of capital volatility. Additionally, if you look at the maximum drawdown for coupons index, the biggest single drawdown on a total return basis that index has experienced is 80 basis points over the last 10 years. So that also highlights the very high level of capital stability in senior floating rate bonds. So I'll breeze over this pretty quickly. I think we've covered the high level of capital stability. I mentioned that this is not liability weighted. The bonds are equal weighted amongst the issuers. And we believe it's highly efficient because it holds the most liquid part of the corporate bond market. It holds only senior debt, and it does not hold to maturity, which helps generate a roll return for investors. Okay, I'll now touch on the BetaShares Australian Investment Grade Corporate Bond ETF. This is CRED. So we're moving now to taking on both duration and credit risk in this exposure. Credit risk because it is investment grade corporate bonds, and duration because we are a fixed coupon fixed income product in the case of CRED. And deliberately so, for reasons we'll cover or have touched on, but we'll cover shortly. Very low management fee here at 22 basis points, expenses capped at 0.03, so 25 bips all in. And the investment grade corporate bonds that we hold must be Australian domiciled and issued in Aussie dollars. Looking at the characteristics of this exposure, the yield to maturity is quite significant here. We're looking at a yield to maturity of 3.92%. And that's quite a bit higher than what you saw with both cash and floaters and senior floaters. And the reason we do have a higher yield to maturity is because we're earning dual sources of return here. Not only are we getting a return from credit risk, as you do with senior floating rate exposures, but you're also getting return from duration or interest rate risk. So combine those two sources of return premium, and you end up with a higher yield to maturity. As with coupon, we would also expect, courtesy of its rebalancing philosophy, for CRED to generate a roll return, all other factors being equal. And in this case, the roll return we would expect, based on the current shape of the curve, to sit at around 80 basis points per annum. So that gives you an expected total return. Excuse the error, it says 4.82%. It's actually 4.72% there. So when you start thinking about ways to put fixed income into your exposure, taking on those dual sources of return, both credit and duration, enable you to receive a very high level of expected total return at about 4.72% for what is an average credit rating of A- and senior paper. Not only is it senior paper, but the ratings profile here shows that the vast majority of paper, in fact over 75% of it, is actually A-rated and above, and there is no sub-investment grade paper held within this exposure. Additionally, you'll see a very diversified sector profile from CRED too. So what is the purpose of CRED? Well, in CRED, we want to provide fixed income for holders of equities. So if you're holding fixed income and you hold equities, you're probably looking to fixed income to provide diversification away from your equity risk. If you want diversification, we've said it many times, you need duration to provide the negative correlation to equities. Credit alone does not do that. So we've deliberately chosen a long duration exposure to provide maximum diversification away from equity risk. We think that's critically important from an asset allocation point of view for investors holding a balanced portfolio. Not only should this exposure provide the best equity diversifying properties of any fixed income exposure we're aware of, but as we just saw, via that expected total return of 4.72%, it's also paying you the most for that equity diversification of any exposure that we're aware of. We think they are two fantastic asset allocation outcomes for investors using fixed income in a balanced portfolio. So, fund characteristics, we target investment grade Aussie dollar denominated and domiciled corporate bond exposures, senior ranked paper only, targeting the 5 to 10 year part of the curve. Why do we target the 5 to 10 year part of the curve? Well, there's two very good reasons. The first is that, number one, in this product, we want duration because duration provides the diversification to equities. And the longer dated part of the curve has more duration and therefore more equity diversification. Secondly, the 5 to 10 year part of the curve is heavily under-owned by direct investors and by traditional broad market indices. As a result of that, it tends to be under-owned by the active managers who track those indices. And that creates what we believe to be a really attractive risk-return profile in that part of the curve. So long duration to provide maximum diversification for equities, to provide the largest amount of compensation based on attractive risk-return profiles or characteristics in that part of the curve. As I stated earlier, if for your particular purposes you want to reduce your duration, then blend cred with something with zero or very low duration like coupon or any of the other floating rate products, and you can pull down your blended duration to whatever you deem fit, but you will still benefit from the attractive risk return yield outcomes that incorporating cred in a portfolio can provide. I've already touched on the fact that it's the lowest cost corporate bond exposure in the market at 25 basis points, equal weighted to avoid the limitations of traditional bond indices. Let's look at the performance of cred's index after deducting fees relative to every active bond manager in the Australian market. And you can see there, cred is sitting as an absolute outlier with an annualized return of around 6.5%. Compared to the majority of fixed income managers, the highest of which is 5%. So that was every active bond manager in the Australian market that we compared this to. Now, if I can call on people to pay attention for one slide, this would be it out of the whole presentation. This looks at the historical correlations of the three primary sources of return or risk premia, being equities, credit, and duration. If we start with duration and credit, they are negatively correlated historically. Why is that important? Because it means if you buy a product such as cred that has both those sources of return, you're generating two sources of return premia, not one, but they're negatively correlated, which helps cancel out the risk between those two sources. Secondly, equities and credit, positively correlated, 0.28. This says to you that if you hold low or zero duration fixed income exposure, that's okay. It may provide good total returns or the like over time if rates rise faster. I'm not denying any of that. But this tells you that if you're holding that and expecting it to diversify equity risk, you're probably historically under a false pretense. Because of the positive correlation between equities and credit, when equities sell off, credit exposure sells off. And a very large number of active managers are overweight credit, and obviously exposures with low duration are overweight credit as well. Finally, and this is the big one, equities and duration, negatively correlated. So it is duration that provides the diversification away from equity risk. Without it, when your equities sell off, your fixed income exposure is likely to sell off too. I think I've largely covered the next slide, so we can skip over that. Credit as an equity diversifier, or CRED as an equity diversifier. The grey line here is the returns of the ASX 200 index. The orange line is a blend of a balanced portfolio, 50% ASX 200 and 50% AusBond Composite Index. Now what you'll see, is that blending in AusBond Composite to Aussie equities actually increased the return from 5.8% per annum to 6.4% per annum. However, it also had the benefit of reducing volatility from 16.9% in equities alone to 8.2%. So that's a pretty good outcome. It shows the benefit of a diversified portfolio. The red line, however, is the same blend of, but 50% CRED, 50% ASX 200. Now, why is the performance better when you blend CRED with ASX 200 than AusBond with ASX 200? Simple answer, AusBond Composite has lost much of its credit exposure due to segment creep and is now largely a duration exposure. So it primarily has one source of return, being duration. CRED, by contrast, has the two sources of return, being being credit and duration. So having the two sources of return mean you have higher expected future returns, and that's shown through in that chart. Plus, because of its higher duration and therefore higher negative correlation, the blend of CRED and ASX 200 is actually lower volatility than the blend of AusBond Composite and ASX 200. So better returns for lower blended portfolio volatility. Finally, will rising rates hurt bonds? Well, look, that depends on what sort of bonds. Obviously, floating rate bonds, no. But if you're talking fixed rate bonds, there are some things to remember. Remember, future rate hike expectations are already priced into the yield curve. So rates need to rise higher or faster than what's already in the curve for a fixed rate investor to be worse off. Secondly, fixed coupon bond exposures that roll into new bonds on a regular basis, like CRED, are rolling into new bonds that are yielding more in a higher interest rate or rising interest rate environment, meaning that over time you would actually expect the future returns to grow in a rising interest rate environment. And it also provides a buffer against rising yields. Finally, on HBRD, so here is floating rate exposure. We're looking at the lowest part of the curve. When you're the capital structure, looking at related to to price these securities. That creates a very happy hunting ground for an active manager. Also, hybrid securities tend to be relatively concentrated, often just 3 to 5 individuals directly based on the feedback that we have, although we invest differently. Putting hybrids in a fund like HBRD can add significant diversity of between the hybrid securities. And finally, hybrids are liquid. Using active management in accessing the best liquidity of the hybrid market. That outcome. As you can see, HBRD has provided since inception and after all fees outperformance of the broad Australian hybrids market for male consideration. It solves the problem of understanding the very complex nature of all the individual securities in the hybrid market and helps to reduce risk from investors on that basis. A couple of things to consider as we wind up. Investment returns will be influenced by market risk and fluctuations of the fixed income market as a whole. Income payments are variable. Investors are exposed to the credit risk of corporate bond issuers. Concentration risk. Hybrids and corporate bonds are predominantly issued by sector risk. Issuance terms of hybrid securities are complex and can differ greatly from security to security, and investors should seek professional financial advice before investing. Past performance is not an indication of future performance, and please see the PDS for more details.
Well, thanks very much for that, Pete. That's obviously a lot of information there for people to take in, and really appreciate all that. We'll just get interactive for the final stage, which is the last question, which is all about the future. So again, for those of you who cannot see that screen, over the next 12 months, how do you plan on adjusting your clients' portfolio allocations towards defensive income? Increase it, stay the same, or decrease it? And we have had a lot of questions. Just due to time and the fact we want to make sure we get everyone out on the hour, we'll come back to those question answers directly. I'll just get Pete to answer one question, and meanwhile, I'll show everyone the response there. The response there is that people are ultimately either going to increase it, a good number are going to increase defensive income exposures, or stay the same. So just the last question for you, Peter, is just one about the coupon fund. The coupon fund is a floating rate bond fund that BetaShares has. There's alternative exposures out there that have a larger number of securities, And the question is, should we be worried about the smaller number of underlying holdings that coupon has versus an alternative floating rate bond ETF with more holdings?
Thanks, Il. Yeah, look, this is a pretty simple question to answer. So Coupon is currently holding 13 bonds, and if you look at those 13 bonds, they would make up the vast majority of the exposure that is held by the alternative floating rate bond product as well. The issue in holding a larger number of bonds is very simple. Many of those bonds have highly illiquid exposures and therefore cannot actually be held within a portfolio. They also have minimum parcel sizes, which means that given very small weightings in the portfolio, it's virtually impossible to actually replicate the index that the other exposure tracks. So another factor, what we focused on was having the best liquidity, tightest spreads, because in those crisis periods, you want to know that you can get access to your money and have liquidity around your exposure. There is one other factor as well. During the GFC, what we saw was the performance of a concentrated banks-focused portfolio did better than a broader floating rate bond product, and that is because during the GFC, the government stepped in and guaranteed bonds issued by the Aussie banks or major Aussie banks, and as such, those banks experienced virtually zero drawdowns in their exposures, whereas other issuers were not provided with that same guarantee. And so holding a broader portfolio actually resulted in you being subjected to much larger drawdown risks in the portfolio in a crisis event.
All right, well, thank you very much for that, Peter, and for everyone's attention. We hope you found that informative. We do have a few questions we'll come back to directly. Thank you very much for your time, and we look forward to being with you again shortly. Ilan from BetaShares signing off.